There, everyone, and welcome to today's Family Office Roundtable. I'm Kat Delgadillo, here to co-host our event with our CEO, Hall Martin, who's going to tell you a little bit more about what we do here at 10 Capital. Hall?
Great. Thanks, Kat. And I want to thank everybody for joining us for another great round of presenters here at 10 Capital. Before we get into that, do you give people a chance to get into the room? Well, let's tell you a little bit about what 10 Capital does. At heart, we help startups and investors connect for funding. Next slide. We do this in several ways, but in most cases, what we're doing is helping startups get their deck ready, get their presentation ready, put together a due diligence room. We build diligence reports today as well. And we're basically making introductions through an event-based program. And we'll talk more about those events in a moment. We also help form capital in the early stage. So we help high net worths start family offices as they fund emerging managers. We help VC funds find limited partners, mostly family offices, and we help angel groups find members because that's how they form capital to put into startups. So we work with a lot of these different groups, and then in return, they look at our deals as well. Next slide. We have several online events. We have the Family Office Roundtable, which you're in today. It's a 2-hour event that talks about topics relevant to the family office. We also have a quick pitch event, and it's for tech companies. We have a life science syndicate for life science companies, and we have an investor education section as well that's sector agnostic. Each company gets 10 minutes to pitch, 5 minutes of Q&A, and then we have breakout rooms at the end. If you want to learn more about our events, go to 10capital.group, click on the events button, and you can see what we have coming up. We also have in-person events as well. If you're a startup and you're interested in raising funding, take a picture of that QR code and fill out the form, and we'll follow up with you to see if our program is a good fit for your fundraise. We've helped over 800 companies raise funding since we started in 2009, and we've raised over $1 billion. So we've been doing this for some time, and we have a good program in place that could potentially help you. Next slide. We also do an Investor Connect podcast program. We've interviewed over 850 angel, VC, family offices on what they invest, how they invest, and how they view the early stage world. And we've captured all that information into a chatbot called Ava. We also run a startup funding espresso. Is in the time it takes to drink an espresso, you can learn something about startup funding and investing. And it's a 300-word micro blog post. It's a minute and a half audio. And we've done over 2,000 of these and have put them all inside the chat box as well. So all you have to do is ask your question and it'll give you the answer. Let's hear more about how it works.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. So our agenda today is we have 3 companies pitching. As I said before, they'll each have 10 minutes to pitch and 5 minutes of Q&A. We have WorldTree first, Enrichly second, Renerva third. Then we'll have a short presentation on capital calls for family offices and how to navigate that world. And before we jump into it, let's welcome or meet our panelists joining me today, Darren Mende. Darren, can you tell us a little bit about yourself and your company?
I can. Hall, thanks for having me today. My name is Darren Mende. I'm a CPA and my firm is Boutique. a CPA firm based out of Chicago, and we focus on working with early stage and small businesses and business owners to help them solve their pain points and grow and scale and finally exit at some point with success. I am glad to be here, and I'm really excited to hear these pitches today.
Great. Also joining us is Mohammed Hachisha, one of our preferred partners of Crown Acquisition. Mohammed, can you tell us about yourself and Crown?
Hi, Paul. Thank you for having me again. Mohammed Hashisha here, founder and CEO of Crown Acquisition Group. We help startups, Series A, Series B, with their financial needs, data management needs, and HR and compliance, C-level executive guidance, and we're happy to listen to the pitches and help in any way that we can.
Great. Thanks for joining us. So with that, let's kick off with our first presenter, WorldTree. Doug, if you could launch your slides, share your screen, and kick off when you're ready. And for those in the audience, if you have any questions, please post them in the chat box and we'll read them out as we go forward.
Great. Thanks so much, Hal. Really great to be here, everybody. I love talking about WorldTree and look forward to hearing the questions today. WorldTree is really disrupting the lumber business in North America. So for those of you who don't know, we have tremendous shortages in our lumber chain throughout the world, as well as in North America. The demand for lumber is set to quadruple by 2050, and yet 30% of species are at risk of extinction. Many species that you know right now are on their way to commercial extinction. Redwood, western red cedar, swamp ash, and birch and beech, things like that. And one of the critical issues is we can't grow lumber fast enough. We can't go into a tree and just manufacture something. It takes time to grow. Most hardwoods take anywhere from 30 to 60 years to grow. So for us, we're commercializing the fastest growing hardwood tree in the world here in North America, the first company ever to do it. It's a very friendly, benign, non-invasive species. Common nickname is the Empress Splendor. Paulownia is the botanical name. You see on the lower left, those are 8-month-old trees on one of our farms in Costa Rica. It's really amazing. The tree on the right is 10 years old in Tennessee. And so we now have more than 7,000 acres planted and rapidly building a base of lumber for us to draw from. So these, Bloomberg called us the world's best carbon capture technology because a tree that grows this fast consumes massive amounts of carbon at the same time. And so up to 4 times more carbon than a typical hardwood would. Again, non-invasive, also nitrogen fixing, meaning they add nitrogen to the soil as opposed to taking it away. Very great to intercrop with other species and crops and things like that. And then the most amazing thing is when we harvest this tree after 10 years, we'll have a tree will be 60 feet tall and 18 to 20 inches in diameter in 10 years. We harvest it for valuable lumber. The tree regrows from the stump. It will do that for up to 5 generations, which is really amazing. So the only truly renewable regenerative lumber on the market. So here's where we are right now, and it's really unique that you get a young company like ours with such a huge asset base. We've been planting since 2016. We actually raise capital every year. It's non-dilutive capital that goes into, through a subsidiary, goes into actually planting trees, partnering with small farmers. We have more than 7,000 acres planted. Assets of more than $300 million in the ground right now. We start harvesting next year. So we're EBITDA positive next year, and we continued our revenue continues to go up as we start to harvest larger and larger crops. We have 9 years of R&D already, which is one of the most amazing things that we've done is that if anyone here wanted to go plant yellow pine in Georgia, for example, you'd have 1,000 different people you could speak to figure out how to do it, what to do, experts you could hire. For us here, there was no one. There was no protocol set out in North America, and we've developed that. It's one of the most valuable things we have. We just had an engineering professor at Arizona State call us the future of lumber in North America. And so we raise money every year, and I'm talking to you today about two capital raises that we're doing. One is one we do every year. Most of the revenue comes in from accredited investors. We partner with small farmers, with investors. We raise money, we plant trees, and then when we harvest, we share the profits. So in the 8 to 10 to 12-year harvest period, we share profits. We have a lot of investors that love to do this to offset their own personal carbon footprint, their company's carbon footprint. The largest investment we've had into this program is $1 million, and smallest is down to $1,200. But it's what's allowed us to build such a big asset base and build out the operations that we have. Here's the typical sort of with a larger accredited investor investing $500,000 into this. You could see the targeted return, which we're on track to do with all of our earlier years. And then there's also significant tax benefits. It's very much like an oil and gas lease where you're able to write off all the expenses until the revenue comes in. So it's about a 55 to 60% passive loss carry forward that someone gets through a K1 after they invest. And then these are just some of the pictures of the product we produce. Really beautiful, high-grade finished lumber for a variety of markets. You can see on the left who we're working with right now, who we're selling into. Those markets total up to $170 billion wholesale value in North America, which is our target market. Most of these supply chains have significant climate change related shortages in them right now. Just an example of a few of the sales we're doing. The biggest issue we have right now is lack of supply. So we don't harvest our first farms until next year, but we're currently selling lumbers to name brand customers right now. Fender guitar, Gibson guitar, Grain surfboards, Bunsen boats. We have some large offtake agreements we're about to announce in the next few weeks that we're really excited about. And this is where we're getting lumber right now. So there's some small independent growers around the country. President Jimmy Carter was one of them. He took 15 acres of his peanut farm 20 years ago, visionary that he is, planted them in Polonia. They grew to maturity, didn't know what to do with them, and someone put him in touch with us. We bought his timber, harvested them, milled them, and have sold them into the market. Actually, some of his wood was made into specialty guitars for these artists that you see on the screen. And so we get lumber now from very small independent growers like that, 15, 20 acres around the US, and that allows us to service the manufacturers that we're working with. We don't start to get really large volumes until next year when we start to harvest our own fields and farms. So we're also raising capital at the parent company level, equity capital. That's so we can scale. So we're at 7,000 acres right now with our EcoTree program. We love that. We're going to continue to do that every year. But the goal for us is to go from 7,000 acres to 50,000 over the next 3 or 4 years. We do that with larger institutional grade projects, partnering with institutional funding partners like Shell, Nestle, people like that who have been very, very interested in partnering with us. And yet their biggest feedback to us is you have to get bigger. You're not big enough. We need $100 million worth of projects to invest in. And so we've developed a couple larger projects in Costa Rica for these institutional investors, and they'd like 8 or 10 more just like them. So we're raising capital at the equity level, at the parent company level, to be able to develop these projects. But you can see an idea of what, a project like this, it's a little over a $16 million investment. Over 60% of that is to buy the property. This would be, for example, a Shell as an institutional partner, and they want $100 million worth of these projects to invest in. And then they sequester massive amounts of carbon. That's one of the reasons Shell wants to invest. But they cash flow in year 2, they produce really strong IRR and multiple revenue streams from carbon credits, timber, annual crops, biochar, biodiversity credits, a host of things like that. So this is the key way that we're going to scale and get up to that 50,000 acre level, which is much closer to, it allows someone to get that 15 to 20x return on their equity investment. These are the pipeline, the properties we have in our pipeline right now that are ready for capital for us to fully develop a project to be able to take them to people like Shell and Nestle. So you see more than 40,000 acres in our pipeline that's ready for capital. We can have all these projects ready for investment if we had capital ready for investment in 9 months. So it's not a long lead time for us to do this work and have them ready for the Shells of the world and the Nestles of the world. So that actually then creates a world tree that's getting revenue from 2 key project areas. One is the Eco Tree program, which I already spoke about. That's our 7,000 acres, our partnership with small farmers, investors. We'll continue that program every year. We love it. It produces great value for both investors, for farmers, for us, but then really scaling into the signature farm projects that I just spoke about that will allow us to go from that 7,000 acres to 40 or 50,000 acres very rapidly. This is what our revenue looks like over the next 10 years. Now, the most important thing about this is virtually all that revenue is coming from timber that's already in the ground. So we're EBITDA positive next year. All of this revenue is really profit. It's work that we've done for 9 years that now we're able to start to get our share of the lumber that gets produced from those acres. So again, it's really rare that someone has the opportunity to invest in an early stage company that has such a large real asset base as WorldTree does. But then the key thing I'd point to down below here in the red box, this is how we really get valued when we look at a liquidity event in 3 or 4 years. It's acres under management and planted that we have. It's the asset value. And this starts to get into a $500 million valuation. So we've got a really great team. I have 2 successful exits. Last one was in healthcare. I like to change industries. We've got a really great board that our board has raised over $1 billion in capital between them, a successful IPO on our board. Got a great team of foresters across Costa Rica, Guatemala, Mexico, the US, and really built to scale. As I came into WorldTree, really built this team to be able to scale to where we think we can get to and where we need to get to.
We're at 13 minutes.
In summary, we've got 2 offers. The first is an equity, Series A into WorldTree itself. We've raised $3.5 million. We've got about $3 million to go. That's one of the reasons we're talking with you. We've got a $35 million valuation. That is just the net present value of the trees in the ground. There's no blue sky whatsoever. There's no future tied into that. That's exactly an NPV of just what we have in the ground right now. So we set that up to be very fair with people. And then lastly is the 2025 Series A EcoTree program that I spoke about, that we raise money every year, that we'd love for folks to take a look at that. And with that, I think I'm out of time, and I'll stop, and love to open it up to any questions.
Great. Darren, thanks for putting your question in the chat box, but go ahead and call it out now.
Excellent. Good presentation, Doug. Thanks for the info. Are you planning on developing in other parts of the world, or is this restricted to North and Central America?
You know, we easily could, but it's a big deal for us to go into a new country. We need a new lab, we need a new nursery. We have to identify where's the market, where's the wood going to go. And so we could easily go into other markets, but boy, there's so much room to grow where we're at, and they're great growing regions. Our focus is really on Mexico, Costa Rica, the US. And if we go somewhere else, it would have to be with the right partner. So for example, Nestle has talked about bringing us into Brazil. We might do that if it's with Nestle, but not on our own.
And as a follow-up, is there enough land available to reach those goals for acreage?
Yeah. I mean, the truth is, you could add 50,000 acres in Mexico alone next year. Just that alone. There's definitely plenty of available fallow, unusable, degraded land, and certainly all three of those countries to be able to get to that point.
Great. Mohammed, what's your first question?
Hey, thank you, Doug, for the presentation. Very informative. You're raising based on a net present value of planted trees and a 10-year growth cycle. So for investors, how do you mitigate risk around biological variances, climate impacts, and even land rights over such a long period?
Yeah. So I will say that that valuation is based on just the first harvest, not the second or third. So that's one thing I'd say. The second thing is wherever we plant, we mitigate risk as much as possible. So we stay away from coastal areas. We're at least 100 kilometers away from the coast, so no hurricane risk. We stay out of fire-stricken areas. We get a lot of requests to plant in California, for example, and we don't. Stay away from drought areas. There's no known virus, bacteria, or insect risk to this species worldwide in the literature. Occasionally, we'll get something site-specific, fire ants on a property in Costa Rica that are eating the leaves that we found an organic way to deal with. We get some deer issues in the US on maybe 1 out of 20 farms. But otherwise, we've been planting for 9 years, 375 farms. We've only had 2 minor sort of weather events that have caused some minor damage. And I think spreading our farms around is one of the ways we mitigate risk, is that if something happens to one of them, it doesn't really impact the returns of the entire planting round.
Thank you. And to follow up on that, what would you say are the main challenges where tree faces in scaling up the supply to the increasing demand?
Yeah, it's interesting because I get the question, how come no one else has done this? And a really quick 20-second thing, the timber industry in the US used to be vertically integrated. In the 50s and 60s, Wall Street pushed them the other way, mainly for valuation reasons. They said, hey, we value the timber assets differently than we value the processing part of it. We want you to split up. So they did. So when you get a new species like this to be introduced, it demanded an entrepreneur. Those companies weren't set up because you had to build the growing side. First of all, no one's going to grow it if they don't see a market. No one's going to go out and market and build the market unless someone's growing it. So it's really a problem that demanded an entrepreneur, one of those things. And Wendy Burton, our founder, was that entrepreneur. She saw the opportunity, heard about this species at a conference, and decided, wow, no one's ever started this in the US. So that's been the most difficult part, is matching those two, the growing and the market. And yet we're really at a really great point of signing large offtake agreements now as our supply is coming into being able to be harvested next year.
And we're out
the
of time.
timing's been perfect.
Great. Thanks, Doug, for a great presentation. Thank you for good questions, guys. Let's bring our next presenter up. It's Enrichly.
Everything came through okay, Hall?
You see your slides, you're good to go.
All right, thank you. Yeah, I'm Troy Medley. I'm the founder of Enrichly, and what we do is we help not-for-profit membership organizations create much needed ancillary revenue and non-membership revenue streams. And besides founding Enrichly, I'm also the CEO of Lambda Chi Alpha, which is the third largest fraternity in the world. So I'm also one of its largest customers. And before joining Lambda Chi in 2019, I'd spent 20 years building and selling companies. And so I was shocked when I got to the not-for-profit world by its complete lack of sophistication. There wasn't modern technology, there wasn't any long-term strategic vision, and there was definitely not the will to utilize its exponential economic potential to increase our scope. And I decided this needed to change for our organization to survive. So today I'm going to tell you about the simplest business you're going to hear about all year, but it is designed to dominate a $400 million market that is hiding in plain sight that nobody talks about. Who knew that there were 9 million Greek alumni in the United States? There are 750,000 Greek college students, and in August, 150,000 new college freshmen will join fraternities and sororities, and they will immediately begin spending likely their parents' credit cards on new fraternity and sorority merchandise. It is a massive, massive revenue machine. But in spite of all of this revenue, only $12 million a year gets remitted back to organizations like mine in the form of royalties. And this is just not sustainable because our organizations are not for profit and our customers are students. And we have to deal with inflationary expense pressure, but we can't pass on price increases to our students because the cost of attending college and tuition is just so great. So we can't pass on our cost. So we have to create new ways of generating revenue if we are to survive. So in 2023, at the end of 2023, my organization partnered with two of the other top 5 fraternal organizations to create Enrichly. And our job is to create a new commerce solution to help membership organizations like ours survive for another 150 years. So let's talk about the root cause of our problem. 80% of that $400 million that we know about is sold in the local college town by a mom and pop that is probably not licensed, not regulated, is selling cheap merchandise to our unsophisticated student that doesn't know that there's a better way. And from that, we end up with lost revenue. We end up with a poor experience for our students. And I don't know if you've seen any shirts that fraternity members wear, but we have no ability to control our brand in mass. And so this is a significant problem. This is exacerbated by our lack of sophistication as an industry. Because of our fragmentation, there's over 200 fraternities and sororities. We haven't been able to work together as an industry to create strong licensing terms or to police our brands from pirates. And so this has just continued for decade after decade. So what I saw was what's really needed is a for-profit trade association that is here to protect our organizations and help us maximize this share of revenue that's already being generated. And so what we've created is the Enrichly store. And the Enrichly store is vertically integrated white label storefronts that become the official storefront for a membership organization. We enter into 10-year agreements, and with that, we get full access to that organization's database. We're able to market directly to its members through its brand suite. So if you get an email from Lambda Chi Alpha about merchandise, it's coming from Lambda Chi Alpha, even though Enrichly put it all together and manages that transaction. And we partnered with CLC, which is Collegiate Licensing Corporation. Collegiate Licensing Corporation manages the IP and brand for 800 colleges and universities. That means two things. One, we get, and we're the only organization that is able to co-brand. So the University of Texas, the University of Alabama with that fraternity or sorority. And then we get the vast array of tools, legal protection tools that CLC has. So now they go out and they police our brands on our behalf. And we've also created just a win-win business environment. So many people have preyed upon our industry that everybody loses today, except for that third-party vendor. Well, we wanted to turn that on its head and create something where everybody wins. So our students are able to buy, our alumni, or just any of our members are able to buy products that are Johnny O, Peter Millar, Collars & Co., you name it, Lululemon, at 5% below bookstore prices. And our chapters get 2% cash back on everything that they spend. Then we've worked with CLC to negotiate with wholesalers. So our customers receive a 10.5% royalty, where historically our industry only gets 6%. So this is significantly more money for the same sale. And then we manage the entire process, distribution process, fulfillment process, shipping process on behalf of these fraternities and sororities that just don't know how. Our customer acquisition cost is about $2.50 on a $35 t-shirt. We give away about 7% margin on that t-shirt to be able to make this win-win business model available, which we are happy to do because right now we're trying to gain market share and put the mom and pop shops out of business. And we have significant traction. We have signed up 4 of the largest Greek organizations. Our trailing 12-month revenue is over $600,000. We onboarded our first sorority in June, which means we had our first $100,000 month. Sorority members spend about twice as much as fraternity men. So we had our first $100,000 month in a month when school's not even in session, and about 70% of that was from the sorority. And we have landed our first non-Greek client, which is the JCs, 140,000 member civic association that goes live in September. Now, this is huge for us because the Greek organization is big. The membership organization market is gigantic. There are 62,000 membership organizations that generate over $13 billion a year, and they are as unsophisticated and as incapable of creating their own ancillary revenue streams as the Greek market. They desperately need the same tools. If you're the JCs, every time you have a civic project, you have t-shirts. You don't know how to fulfill that for your members, and you don't know how to make money off of that. And we can show them how. And we have massive competitive advantage built in to our solution. For one, we enter into 10-year agreements and we become the official store and get access to that database. To the end user, we are the organization they love, and you cannot fake that type of access or authenticity. We also have compounding network effects. The more organizations we sign up, the more members we have, the more transactions we create, the easier it is for us to get the best brands at better prices, which means we have more transactions, more organizations, and then more referrals. We got the JCs from a fraternity client, and through the JCs, we're now working with the National Association of Asian Professionals. We hope to get them landed soon, and we will continue to build our customer base, our enterprise client base, through these referrals. And then we're building a massive data machine. We're going to have the opportunity to track buying behavior from 9 million of the most educated and affluent members of society, including the all-important 18 to 25-year-old demographic. And I don't know if you guys have college-age kids, but whatever they're wearing at the Cayo House at Alabama or in the Kappa Kappa Gamma House at Ole Miss is being followed by every other fraternity and sorority member on TikTok. And that brand becomes cool about 2 semesters later. Look at Aviator Nation, look at Daily Drills. This was all fraternity and sorority led. And I think this data will become our most valuable asset over time. We have a lot of gray hair in this startup. We have over 100 years of C-suite experience. I have built and sold 2 companies, one to private equity, one to a large regional healthcare system. Our chief legal officer used to be the chief legal officer for the largest furniture conglomerate in the world. Our CFO was the CFO for a $300 million e-commerce company. The chairman of our board was the CFO of Burger King, a supply chain expert. We've got Greek CEOs, tech, and private equity on our board. Our financial pathway looks strong. We'll do just shy of $1 million this year, $3 million next year. We'll grow to $55 million with about $20 million in EBITDA by 2030. That's a product of going from 4 managed organizations to 40 and dramatically penetrating those accounts to drive sales at the university level. We break even at 7 organizations and about 140 chapters utilizing our bulk sale services, which we expect to happen in December 2026. There's going to be a large number of people looking to acquire us, most notably CLC, Follett, which manages most university bookstores, and BSN Sports, which pretty much owns all of the high school, university, and cheerleading uniforms. They've already inquired about working with us. They don't understand how to work with the 19-year-old student, which is what we do each and every day. And it's going to be a lot easier for them to buy their way in than to try to build some bridge to communicate with the student buyer. We have raised $1.8 million to date through the 3 founding organizations and our alumni, including myself and Lynn Chipperfield. We've use that to figure out what to do and most importantly what not to do in scaling this business. And now we're raising $2.5 million through a convertible note to scale. We need to automate our supply chain. We need to underwrite inventory for bulk ordering at the chapter level. And most importantly, we need salespeople. We have enterprise accounts to bring on board, and we need to then work with the student decision makers across the universities to drive revenue. So in closing, we're not building a market. We're just consolidating a $400 million market where the customer is our member. People have been making money off of our brands for 100 years, and we're tired of it, and we're going to take our money back. So with that, love to answer any questions.
Great presentation. Mohammed, what's your first question?
Hey, Troy, thank you for the presentation. Looking at it, like your financial hinges on scaling to 40 plus clients and 180 active chapters. How do you manage client acquisition cost and retention when your primary go-to-market relies on bespoke organization level onboarding and affiliate chapters?
Well, I mean, we all have different brands, but we're very, very similar in how we operate. And we all know each other because we're all in the same, North America, the NIC. We all work together. So what we do is with any, let's say we land Phi Delta Theta, which we have, which is the second largest Greek organization. They have 180 chapters. Well, the 20 that are important are our atomic network, or the top 20, they're 20 biggest. So we work with that Phi Delta Theta. We make contact with the T-shirt chair in every one of those chapters. And yes, they have a T-shirt chair, which is usually a 19-year-old who knows nothing about business. They know nothing about branding. They got elected because they're personable, And they use the mom and pop shop down the street because it's convenient. So we work with Fidel. We go in and we help them build out an annual merchandising plan where we take into account every single football game, every single date swap, every single time mom and dad are going to be in town, and we help them create a sales plan for the coming year. That allows them to buy the merchandise cheaper, get cheaper shipping cost. We help them with the design. They get 2% cash back. And that's the same at Fidelt, at Teak, at SAE. It's the same process. So we've kind of, and then we hire people that were presidents of their fraternity or sorority that have worked in a sales organization for a couple of years, don't like selling insurance, and want to come back and spend their time on college campuses. So that's kind of how we rinse and repeat this process over and over. Everybody else follows what the kids at Ole Miss and Texas and Georgia are doing. So we have to be really, really good there and let TikTok and the social networks, kind of drive sales at the University of Akron's and the University of Bowling Green's, where we just don't have the manpower to work with them directly.
Thank you. Thank you.
Great. Darren, what's your question?
You brought a great presentation, Troy. Thanks for the info. You brought up that there's these mom and pop shops on all these campuses that are selling all this. It seems that there's a lot of physical presence where someone can just walk down the street and go buy what they need. Is there any plan to, or how would you displace those? Is there a plan to have any physical presence, any bricks and mortar, or partnership with the bookstores that would allow you to kind of tap into that or replace it?
Well, every fraternity or sorority is a brick and mortar. The sorority shops, they do pop-up shops at every recruitment event, football games. So we're going to utilize our student base, pay them as 1099s to do pop-up shops. We're just going to do it in a very planned way. The mom and pops charge a much higher price. They have minimums. We hate them. Not we hate them. Our students hate them. They need to be put out of business. So I don't think anybody's going to feel sorry for the person that's been overcharging for 30 to 40 years. The bookstore, they're not selling to our members. They're selling to mom and dads on game day it's convenient. We don't see them as competitors. They're way overpriced. We see this as a bulk sale opportunity through the chapters for the events that they hold over and over again, year after year. And there's so much margin here that we can give a little bit back and be a much better buy for the students.
Excellent, thank you. And just following up, or with a follow-up question regarding IP, you talked about protecting the IP for these very sororities and fraternities. How do you go about doing that with so many different players involved? And what kind of teeth can you put into that in protecting their IP?
It's one of the deals we have with Crescent Licensing Corporation, and one of the reasons we wanted to partner with them, because then we can piggyback on the university's brand, and they have a lot more capital than we have to protect.
Sure.
The local mom and pops in the bookstore will not infringe upon the University of Texas's brand or the University of Georgia's. But we have built into our model about $5,000 a month per brand to combat pirates. So usually a cease and desist letter will do it, but then following up and potentially taking them to court if we have to.
Okay, excellent. Thank you.
Great. And that's our time. Thanks so much, Troy, for a great presentation.
Thank you.
Next up is Renerva.
Hello, thank you, everybody. Let me just put this on the side. Allow. I will present mine, I believe. Can you see my screen?
We see it now.
Well, thank you, everybody, for having me. My name is Lorenzo Soletti. I'm President and CEO of Renerva. Renerva's mission is to develop implantable technologies for peripheral nerve injury. As you might be familiar, the peripheral nervous system is the apparatus that connects the periphery with the brain and communicates sensation and motion and pain. As such, it gets injured in several different ways through trauma, iatrogenic injury or medically induced injury, or underlying disease. In particular, in the case of extremity amputation, which involve, of course, the transection of a limb, as you can understand, that leads to the terminal injury of multiple nerves for each extremity amputation. There's a high incidence of development of what's called painful neuroma, which is an irregular growth of the nerve, which cause chronic pain. This has a severe impact on quality of life of patient, has tremendous psychosocial impact, and also leads to opioid use disorder. This is a $2.1 billion market in the United States. So Renerva, we believe in a future in which no amputee should suffer from chronic pain because it should be available a solution that is simple to use, affordable, and more importantly, highly effective. This is a critical time for an opportunity like this, as leg amputation, for example, is the #1 surgical reason for development of opioid use disorder. As you know, the condition often develop as a sequela of a surgical procedure due to post-surgical pain. There's high momentum from a policy standpoint. The COVERT Act and the CMS Innovation Center have demonstrated that the federal government privilege and provides incentive for solutions that reduce and can prove to reduce the opioid use or consumption. And also there's critically a high need. Despite there is a solution that is highly complex and expensive that actually works to prevent neuroma, this is so complicated and requires such a specialized care from a surgical standpoint that less than 3% of patients actually get it. So at Renerva, our first product that is now fully developed is a nerve capping technology. So this is an implantable medical device that gets connected at the end of each transected nerve end. We've shown in multiple high-quality, high-impact factor journals and publication and studies that we have a 17-fold reduction in nerve growth. Nerve growth is a necessary condition for the development of neuroma, which is based on irregular growth. So if we prevent nerve growth, we can also prevent the formation of neuroma. So we've shown great neuroinhibitory properties of this technology. We've also shown in a separate study a 3.5-fold reduction in pain. Now imagine a patient suffering from chronic pain, what that means with regard to reducing a 3.5-fold to a 3.5-fold level, the level of pain. That might be the difference between living a normal life and living a life of a hell. Frankly, we have 3 patents family that are protecting this first product. The first of which in the US just received a notice of allowance, so was just issued. We've also received a favorable informal freedom to operate assessment in the United States. The technology works in a pretty simple manner. As I mentioned, it's a cap that can be sutured and connected by any surgeon at the end of each nerve that is transected. The technology offered the unit of nerve electrical conduction, which are called axons, the opportunity to grow in a limited fashion within the device. But most importantly, the opportunities to grow in a compartmentalized. So this unit of growth are not allowed to entangle with each other and with itself. This is a mechanism, the entanglement, that actually leads to the formation of neuroma. In the process, the technology degrades over time and progressively over the course of 8 to 12 weeks becomes essentially patient's tissue that encapsulate these axons that are now frozen in a permanent and stable configuration. As we've shown, up to 2 months after full device degradation, the nerve is in a stable and permanent condition. So this is not a temporary fix. It's not just a temporary fix. Physicians and user would have the opportunity to use something very simple to use that has the ability to improve the outcome for their patient. So that's where would be their interest. For patient, of course, is self-explanatory. And for providers, there would be an increase in profitability upon reaching dedicated reimbursement code for the technology. Most compellingly, especially upon market entrance for payers like public and private insurance, they would see a dramatic reduction in total cost of care. If you imagine from a payer standpoint, the sequela of care for an amputation patient would be an initial amputation procedure, which is reimbursed at about $30,000. Then the development of neuroma and therefore follow-up treatment and care, which obviously will lead for sure to another surgical procedure, because once the neuroma is formed, the only non-palliative solution is essentially another surgery. Now, this costs another $20,000 to $30,000. So what we offer as an alternative scenario is to use in a preventative fashion our technology at the level of the initial amputation with just a marginal increase in the cost of the procedure. The neuroma market in the United States, it can be split in the two segments of prevention and treatment, where prevention, of course, is the larger opportunity. These represent a 2.5 billion US total addressable market and a global estimate of about 6 billion. The technology will position itself in a competitive landscape that is characterized by either technology that are adopted very often but don't do anything, they don't work very well, or technology or approaches that are ultra complicated, very expensive. They work fairly well, but as a result of the complication and the high cost, they're really not adopted at all. So the competitive advantage of our Renerva PNM cap would be to offer affordability, ease of use, and high efficacy, which is obviously something that is missing in the space. The technology will be regulated as an implantable Class 2 medical device. This is a lean and predictable path, which is called 510(k) or market clearance path. We have identified a necessary predicate device, and we will not require clinical data for market launch and market approval. We have performed a profitability analysis in the inpatient setting for amputation and established that there's an average $8,000 in profit for any amputation procedure. We believe that upon market entry, we will leverage and tap into that profitability to support the cost of the technology before dedicated reimbursement is obtained. We're a team of dedicated professionals with significant experience in various functional areas. Pete DiComo, one of our board members, has successfully exited two medical device companies. We've also have a medical advisory team that composed of key opinion leaders in various areas of peripheral nerve injury and repair, and also peripheral nerve science. Our timeline moving forward is we are 1 to 4 months from an approval of the FDA to allow us to conduct a pre-market clinical study, which is something completely independent from our market launch, and is purely meant to investigate and start generating as soon as possible clinical data, which is required for reimbursement. We will also submit a 510(k), which is the request for market approval or market clearance, and we are about 10 to 12 months from a market launch in the United States. So in the past quarter alone, we received significant momentum with the publication that was published in a high impact factor journal, the patent allowance that I mentioned earlier. We have submitted this massive package to the FDA, which is called IDE, so a request for approval for clinical study, which will launch us into a clinical phase company. And we also have $800,000 pending in grant, which will be received by the end of the year. We're currently raising a bridge to Series A round with a target raise of 1.5 million. We have more than 160 that is being committed today. This is a convertible note plus warrants. We will use this money to support this clinical trial that I mentioned earlier, and to essentially launch, arrive until market approval in the United States, upon which we would leverage a Series A to launch the product. The terms are very favorable for angel investor, for any investor investing in this round. In summary, we have a technology that really have the potential to make an impact for patients that are suffering. We have received significant vetting from federal agents in the form of very significant non-dilutive capital raised to date, and user and investors. We're awaiting approval for entering into our clinical stage, and we have very favorable investment terms. I'd be happy to answer any question at this time. I have plenty of follow-up slides if you have any specific interest. Thank you very much.
Great presentation, Lorenzo. Darren, what's your first question?
Uh, Great job, Lorenzo. Appreciate the information. Can you talk to me a little bit about the manufacturing process and where that'll take place and what it looks like from a facility standpoint, whether you're planning on owning, property or what?
Yeah, no, it's a great question. We have a fully developed production supply chain that is, of course, outsourced. This involves several qualified vendors. So as you might know, medical technology have very strict requirement and qualifications in order to be an approved vendor. And we have a partner, so part owner in Renerva, that is a contract manufacturing organization just based in Seguin, Texas, so close to U-Haul. We have already performed 3 batches and manufactured 3 batches of pre-commercial products. So we have a very clear sense of the cost of goods sold and the initial margins, which are in excess of 94%. So the unit cost currently $72 per unit, and the average sale price would be $1,400. And so essentially it's pretty well established. The company is meant to demonstrate market validation in the United States, small scale market validation before pursuing an exit through a strategic acquisition. We believe that we have all of the volume and the capacity that the company will need at the time of acquisition with regard to manufacturing.
Are the other vendors also US based, or are you using non-US based?
It's all US based, from Indiana to Texas, California, but we're all US based.
And following up, or the follow-up question to this, what are the typical numbers per surgery? Is it 5 units? Is it 1? I mean, how many
It's a great
actually
point.
go in?
So the average any amputation transect critically on average 3 main nerves. We will collect more information as in terms of customer preference and usage when we start launching the product. But we believe that the physician would use the technology at a minimum one product per amputation, 1 unit per amputation. We will also offer different combination products, let's say below knee combo or above knee combo, which would have the most, the product will be offering different sizes depending on the size of the nerve. So we will offer, for example, the below the knee package, which would be offered, at that discount price, for example, with 3 devices within to connect to the 3 main nerves that would be transected in a below the knee amputation. So the average uses is, we believe this is going to be between 2 and 3 devices per amputation.
Okay, thank you very much.
Thank you.
Mohammed, what's your question?
Hey, Lorenzo, thank you for the presentation. Very insightful.
Thank
For
you.
me, the one thing that struck out is you're forecasting clearance in under 12 months without clinical trial data. And even in the slide, you're saying that maybe it's going to be 10 patients, if I'm correct, if I remember. Isn't that a small number of patients for a clinical trial?
No, it's a great point. And I understand that it might have been confusing because there's a lot of nuances there. I didn't want to overcomplicate, but the clearance is completely independent from the clinical trial. So we will not need to present any clinical data for obtaining market clearance in the United States. The pilot data in 10 patients, you're also absolutely correct. 10 patients is a small number of patients. The reason why we opted to have a 10-patient study to start prior to market launch is because it's affordable and also because we've already been leveraging it's essentially a simplified path to receive an approval very quickly, which is called feasibility IDE, which essentially allows the company before being fully ready, for example, for a formal market submission, to test the device and collect clinical evidence early on. And one of the goals of this study, which, as you pointed out, is not going to be statistically powered, but is going to be sufficiently compelling to show initial evidence of efficacy, and most importantly, initial validation that the technology can indeed be used to reduce opioid consumption, which is something that, despite we have tremendous animal data, we cannot test in animals. So as animals are not able, there's no really suitable model for opioid consumption in animal.
Got it. And Is your bridge round contingent on regulatory green lights?
Could you please repeat the question?
So is the bridge round contingent on getting the green light from the FDA or not? Not really.
No, we have not formally launched the round yet. We have all the term sheet ready. We're just finalizing the legal documentation. We are completely ready to raise the round as a bridge based on our comparable review of the past 50 comparable Series A deals. We are also technically ready to raise a Series A. This would be a $10 million with a 20 plus pre-money valuation. The reason why we're raising a bridge to our Series A is to increase our runway, not because we need to reach any milestone. We know that we already have the correct stage to raise a Series A if we have enough financial runway to do so. So we are just beefing up on our finances to then tackle a Series A financing early next year.
Thank you. Thank you, Lorenzo.
You're welcome. Thank you.
Great presentation. Great questions, guys. We're at the end of our pitch sessions here now. What we're going to do is have a short presentation for limited partners and family offices about capital calls. I'll share my screen here in a moment and we'll kick off into these slides. And then afterwards, we're going to move into breakout rooms. So let me go and get the shares up here right quick. And the poll is still up there if anybody wants to vote at this point. And then can you see my screen now, guys?
Yeah.
All right, great. So with that, let me go ahead and kick into our presentation. One of the challenges family offices face as limited partners is navigating the challenges of the unpredictable capital calls and distributions. Many of the agreements from VCs with their funds require capital calls when needed, not when planned. And so it's difficult for them to forecast their needs. There are software tools out there I see many family offices using, like Base and so forth, that do pacing software. They keep track of the capital calls. They try to estimate when the next one's going to come, and they keep track of where that cash might come from, the family office's assets. So that's one thing we're trying to figure out is how do we make that an easier process as well. So if I click into this and let's see, go over here. Let's see.
It may be the play button, Hall, on the far right corner.
Okay.
Top.
You're talking about this one?
Yes.
Okay. Get it to full screen here. So, okay. So what we're going to do is look at some of the challenges here and also some of the solutions that come into it. What we find in this area is that there's, the timing is unpredictable. And what we're trying to do is figure out if we can get more information on what the limited partner, needs to watch, and the general partner, if the general partner has plans to make certain investments in the coming 6-12 months, maybe they can signal that in advance to them. And then they're trying to make sure that they understand that sometimes there's going to be unexpected calls for capital that come up and where the risk might come. There may be a portfolio or two that might need a certain amount of money. And so we want to get visibility on that as well. And then sometimes there's just, trust issues between the limited partner and the general partner, trying to figure out who's really in control of this thing and who's really watching this thing, and are we watching it very well. And then there just needs to be a certain amount of liquidity in the limited partner's position that they can actually handle anything that comes up. So these are some of the questions that we get into in this world of capital calls. And so some of the strategies that come up is there are different cash reserve accounts out there that can help you move money into cash and keep it there at high interest rates, or in today's world, private credit, short-term bonds and so forth, to help give you an amount of liquidity that you can handle this. And then you can actually do measure against the forecast that you're getting from the general partner about the needs and what the next capital call might look like and where it might be going. And so you want to start doing some forecasting and testing on that to see what you might need to be putting up. And then you always need to have a diversified portfolio. We can't put all of our eggs in one basket. And so we're looking to see how do we get multiple tools working for us in this way. So if we go to the next slide here, So forecasting becomes one of the key issues. We need not just a simple forecast, but a more robust forecast. We need to see what each portfolio is doing and what the portfolio needs might be and what the general partner is thinking they can do for it. We need to understand their follow-on funding model, how much they plan to follow on, how much of the fund they have reserved for dry powder for each particular one, and when they would actually pull it. I find oftentimes the VC has all this information, but they aren't necessarily sharing it for one reason or another with the limited partner. But I find if you go ask for it, you'll find that it's easily readily available. Next is ongoing communication. Relying upon a quarterly report is really not going to be sufficient anymore. You really need to have weekly and every other week updates from the VC about how these things are shaping up, and maybe access directly into the model that they're using for determining follow-on cash calls. And then the last one is contingency plans for distribution. Many LPs are looking for earlier cash disbursements on some of the funds, even though there may be risk of clawbacks because they can use the cash for other things and understand clawbacks could happen. But what we need is more information about what are the potential distribution opportunities that can come up to keep these things going. Go to the next one. So, basically what we're trying to deal with is there's a lack of liquidity that some LPs carry. You have to increase your liquidity to cover some of the capital calls. Lack of transparency by the general partner is one of the issues. We just need to ask for more information. What are their forecasts? What do the models say? Can we get access directly to the model? Can we get more information, not just quarterly, but every monthly or even more often than that, just to update the model that the family office has in running and keeping track of this. Like I say, there's many new software tools out there for the high net worth and the family office. I see many tools for alternative asset pricing, for pacing, for tax, for other things. And these tools can take in these models and help the family office prepare better because it's got more visibility coming into it. But it's only as good as the data that's coming into it. So these are some of the trends that we're seeing out there right now. What we're seeing is that there's a good move toward just more transparency from the general partner, looking hard at the different strategies LPs need to keep track of these different groups and having funds available from different cash sources. And then if you have this clarity going on, then you're going to be much more efficient. You won't need as much cash set aside in the bank for when it comes. You're able to pull it from other sources when that time comes. A lot of groups are now getting into technology integration. The fintech world is providing more tools that let the systems from the general partner and the systems from the LP partner talk directly to each other. I think those systems are becoming more mature, and so it's something to explore. Can you tie your system together so you get the information automatically? So they change it at the GP level. Does it show up at the LP level? And then there are some new regulatory changes that are making it easier to manage some of these cash reserves that are out there. You can do different things. There are tax consequences, but there are some things you can look at it. So the goal is to come up with a more structured approach to keep track of capital calls as they come out and adjust your situation according to them as well. So at this point, this is something for you guys to look at. I'll stop sharing my slides, but if there are any questions, please put them in the chat box and love to hear what you guys have to say about that. And then when we're finished with that, we'll move into our breakout rooms. So let me get these back up. And let's see if we have any questions. No questions in the chat box. So with that, we'll go ahead and close out the formal portion of the meeting and we'll move into breakout rooms. Kat, are we ready for the breakout rooms?